Hi everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, October 18th, 2025. I hope you're doing well. I hope you're having a nice weekend. I hope you had a good trading week last week, and I appreciate you coming to my weekend review. I hope you are going to find it helpful. The format today is, first of all, we're going to run the U.S. legal disclaimer. And then we're going to come back. We're going to take a look at all the trades that I made last week, all the new entries, any exits, and then we'll talk about the open positions I have and how I am going to manage them going forward. So we're going to talk about when I entered, why I entered, what the signals were, what the confluences of indicators or entry signals were, how I took the trade, how I position size, how I place my two stops, how I take partial profits if the trade goes my way, and then ultimately how I am going to exit the trade fully. So when I entered, why I entered, and how I'm going to manage the trade going forward. And I hope this will be helpful for you to see real life trades and get an idea of my thinking of how I enter the trade and how I manage it. After that, we are going to talk a little bit about trader psychology. Trader psychology is the most important skill in trading, the ability to create a plan and to follow the plan. That is the most important thing. That's what you need to have. You need to have the consistency. I mean, you need to have a rules-based approach, in my opinion, but then you need to have the discipline to follow that. So we'll talk a little bit about that. It's always helpful for me to teach trading psychology, and I hope it's helpful for you as well. And then after that, I went down through my master watch list last night. I do this every single Friday night, and I go down through each symbol in my master watch list, and I look for confluences of signals for the upcoming week. Last night, I was glad to have one of my students, Vivek. He accompanied me on this journey, and I think it was good. It was a good teaching moment. We went down through every single symbol in the watch list, looked for those confluences, combinations of indicators and levels lining up, and later on in the podcast, I will go through each one of those and show you what I found. So it was great doing that, Vivek. Thanks for your help, and hopefully that was good for you as far as teaching goes as well. So we'll go through there, check them out. I think I've got some good potentials for next week. They're not there where they need to be yet, but if they were there, I probably would have already taken them. But it's something good to watch for next week, because anything that I'm going to be highlighting is coming into some kind of legitimate level to consider taking a position. So that's the format for today. If you find anything helpful in this podcast today, I would appreciate it if you could hit the thumbs up button or subscribe to the channel. It helps the channel out and let YouTube know that there's some valuable content. So let's get this U.S. legal disclaimer out of the way, and then we'll get started. So hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with first open position. This is McDonald's. This has been a really nice trade. You know, when you take a trade and it immediately goes up, it's the best trade, obviously, right? So let's talk about McDonald's and why I entered. I entered here on the 9th of October at 294.30, so really good entry. This is a order block entry, and it also has a bit of a deep dip buy combination with it. But let's first talk about the order block. Let's first talk about what an order block is, because I use order blocks in, I would say, 90% of my trades, and you should learn order blocks. They will revolutionize your trading. They really will. So the order block, you can see the high in the order the high and the low of the order block starts back here on 724. So this bar on 724, the high and the low of this order block moved into the future, is the order block. So why is this an order block? So the first thing you need to know with an order block is you need to have a swing low. Here we have a swing low, followed by a swing high. Here's the swing high, followed by a lower swing low, and then you need to go above that first swing high. That changes market structure from bearish to bullish. And as soon as you change market structure, now you can identify where the order block is to your left. It is the lowest closing bar before market structure change. So we take the high and the low of this bar, we move it into the future. This is the buyable area. Now, let's take the high here. Here's the high on 9/4/25. I already know where the bullish order block is here. But if I were to look at this on 9/4/25, and I look back to where this order block was formed, could I say that in hindsight, smart money was buying here? Yeah, absolutely. Absolutely. If it's up here and you look back here and this is the order block, it's a pretty safe assumption to say smart money was buying here before this big run. So if in the future we come back to that smart money area, will it bounce there again? Maybe. Maybe not, right? Things can change. Things can change with the economy or news or situations. But more times than not, if you had a prior smart money area, it will be smart money again. About over 70% of the time in my experience. So when I have a swing low, followed by a swing high, followed by a swing low, then we break market structure to the upside. Now I can define my order block, lowest closing bar before market structure change, move that into the future. If in the future you come down into that order block, that is the place I will consider buying. And that's exactly what I did. So we've defined the order block, we've brought it into the future. I was patient for it to come back to that level. And then here, on the 9th, when I entered at 294.30, question might be, why did I enter on this day? Why did I not enter on these previous days? Well, the reason I entered here on the 9th was we rejected the bottom of the order block. And all that means is we went under the order block and then closed back in it. That's a rejection. This is of the bottom. This is a rejection of the high of the order block. That's still valid. But what I liked about this particular day is that we rejected the bottom of the order block, and from an RSI perspective, we got right almost to the 30 RSI. So rejections of the 30 RSI are a deep dip buy strategy. And so I combined the deep dip buy strategy with the order block rejection, the bottom of the rejection of the order block. So that is more confluences, right? The more confluences you can have happening at the same time, the better chances you're going to have for a profitable trade. So rejection of the order block, bounce at the 30 RSI was my entry. Now, the most important thing when you decide, okay, there's my entry, what am I going to do, is your position size. Later in trader psychology, I'm going to talk about this, but let me give you the formula that I use to figure out how many shares I am going to buy once I have a signal. It's very simple. First thing I need to know is how much do I have in my trading account? And the second thing I need to know is what is the value of the 2 ATR? You can see I have the 2 ATR right up here. Right now it's 836. So the first thing I do is I take 1% of however much money I have in my account. If I have $100,000, 1% is $1,000. If I have $1 million, 1% is $10,000. If I have 50,000, 1% is 500, right? So it doesn't matter, but let's just say it's $100,000. So 1%, $100,000 is $1,000. Now I take that $1,000 and I divide it by the value of the 2 ATR. An ATR means the average true range, or in other words, how much is this particular stock expected to move in a day? it's expected to move 1 ATR. So I want to take that value times it by 2, and my charting software just does the math for me. So you hear me talk about you have to position size based upon the volatility of the market. Well, this 2 ATR is telling you what the volatility of the market is. So I take 1% of $100,000, 1,000, divided by 836 or whatever it is on that particular day. This tells me to buy 119.6 shares. So just going to round that up to 120 shares. This for me is the proper amount of shares based upon the volatility of the market vis-a-vis the 2 ATR and the total amount I have in my trading account. 120 shares. So off I go. I have my signal. I enter 120 shares right here, 124.30. Now, the very first thing I need to do is take my entry price and subtract that 2 ATR value. That will show me what my emergency stop is. So I take my entry price minus the value of the 2 ATR, whatever it was on that day, and I put it below my entry. This is my emergency stop. Now remember, if I have 120 shares and it goes down 836, I just did the math. How much would I lose? I would have lost $1,000. That is the worst case scenario for me. Pretty much the worst case scenario for me is that if I lose 1% of my trading account, that's it. I'm done. It's over, right? But the good news is hitting your 2 ATR stop, it definitely happens. But it only happens about 5% of the time. The other 95% of the time, if you have a losing trade, if I have a losing trade, it's going to be because of my end of bar stop instead of my emergency stop. And my end of bar stop on this particular trade, if I have a rejection of the bottom of the order block, if the next day it had closed below the low of the order block, I simply would have gotten out. And even for a penny, if it closed below a penny, I'm still out of the trade. Did I lose 1% of my trading account? No, not at all. I only lose 1% if it goes all the way down here. If it closed here, okay, maybe I lose 0.15% of my account or 0.2% of 1%, right? So 5% of the time, yes, I hit my emergency stop. The other 95% of the time, if I have a loss, it's going to be a much, much smaller loss than my emergency stop. So this is important because in trading, you can be patient, you can wait for a setup, but you really don't ever know what the market's going to do, clearly, right? We never know what it's going to do, but you have to have rules in place that tell you if I'm wrong, and it's okay to be wrong, you're going to be wrong a lot. But if I'm wrong, I could be wrong small. But if I'm right, I have potentially a big move up to be right. And this is exactly what happened with this trade. So, rejection of the bottom of the order block, bounce at the 30 RSI, I position size based upon the math that I just showed you. I place the emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. It's very close to that to begin with. The next thing I do is I place my 1.5 ATR trailing stop level. So I take my entry price, and then I look over to the value of my 1.5. The 1.5 is 6.27. So I take my entry price plus 6.27, and I put my trailing stop level above it. We place the emergency stop below it. We place the trailing stop level above it. So why do I do this? Well, if the trade starts moving in my direction when it gets to a certain point, which is my 1.5, now I want to tighten up my stops, right? I have a nice gain going. I don't want to give it all back. So what I do is I go into trailing stop mode. If I get to my 1.5 ATR level, like I did on this bar here, now I go into trailing stop mode. All that means is that now in the future, if I have a close below a previous bar's low, I will exit half the position. And what that does, by exiting half, it moves everything up, right? It's a great way to tighten everything up. Okay, now, everything I've talked about so far as the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves. So in other words, if I take the trade and it goes against me somehow, I need to take action. That's defensive. I'm reacting to what the market's, if the market's doing something that's going against my position. But I also like to be balanced, and I also like to play offense in trading, not just defense. And the way that I do that is that I take partial profits if and when the market moves a certain amount each day. And so I'll show you exactly how I do that. It's not hard. All I need to know is what is the closing price of the day. Right now on McDonald's, the closing price of the day is 308.09. So we'll put in here 308.09. Now I come over here and I look to my value of my 0.45. The 0.45 value now is 188. This is going to change every day. So it's very simple. I take the closing price of the day, 308.09, plus 188. This tells me for tomorrow, for the next trading day, my first profit target for the day is 309.97. Now, I place 3 profit targets every day, but let's just start with the first profit target. If on Monday it goes to 309.97, I'm going to take some profits. How much? It's very simple. 10% of however many shares I have going into the day. If I have 20 shares going into the day, I would sell 10% of that, or 2 at the first profit target. But I do it 3 times. So for the first profit target, closing price plus the value of the 0.45, 308.09 plus 188 is 309.97. That's my first profit target, to sell 10% of however much I have going into the day. I do it again. I take my first profit target, 309.97, plus again 188. That gives me my second profit target for Monday, 311.85. And again, I will sell 10% at that of however many shares I went into the day at that second. And I do it one more time. I take the second profit target, 311.85, plus 1.88. And so that's my third profit target for Monday. And if I go into the into Monday with 20 shares, I would sell 2, 2, and 2. If Monday it goes down, I don't hit any profit target. If it goes up a little decently, maybe I hit 1. If it goes up really good, I hit 2. If it goes up great, I hit 3, right? So that's the balance of being defensive with emergency stops, end of bar stops, trailing stop mode, and being offensive by selling into the strength, okay? And I'll show you a few examples today of why that was so important. All right, so that about covers everything. So let's just kind of start new, and we'll follow the trade and we'll see how we did. Okay, I have a rejection of the bottom of a past order block. We bounced near the 30 RSI. Boom, I'm in. I positioned size correctly. I got in at 294.30. I placed my emergency stop 2 ATRs below. I placed my end of our stop a close below the low of the order block. I placed my 1.5 ATR trailing stop level above, and off we go. The next day, up nicely. I believe I hit 2 profit targets into that strength. Next day, up again, hit another profit target, and also got to trailing stop mode. So it doesn't mean I do anything. It just means that I am now in trailing stop mode. If in the future I have a close below previous bar's low, I'm going to get out of half. Next day, up again, sold into that strength some potential or some profit targets. Next day, up again, another profit target. Thursday down, no profit targets, I don't believe. And then Friday up again, I did hit 1 profit target. So I'm selling into this strength. I'm in trailing stop mode, but I have not had a close below previous bar's low. Therefore, I don't do anything. Currently, we are at a 60.34 RSI. If next week we get to at least 65 RSI, then I have other rules that are going to come into play, and I'll tighten up my stop even more. But just to show you, if we even touch 65 RSI next week, now this 5 EMA will be my trailing stop. And if I have a close below that 5 EMA, I'm simply going to be out of the trade. So, and also, if we go higher, reject the 70, I have rules there, right? So you have to have rules regardless of what you're doing. Once I took this trade, if it went down and closed below the order block, I'm out. If it went really down, hit my order block, I'm out. If it moved up the way that I did, great, I'm going to take partial profits. I have to look for certain levels to get up to, right? So I have a lot of rules. I use these rules every day in my life. I teach these rules to all my students around the world, but whether you follow my rules or someone else's rules, doesn't really matter. It's just whatever you're comfortable with, but get some rules and follow them. So McDonald's doing quite well on this trade. The remaining shares that I have currently up 4.5%. Netflix. All right, Netflix, another order block trade, and also incorporating this megaphone trend line. Let's start with the order block. We had an order block from the past. We came into the order block. This day here was legitimate, rejected the bottom of the order block. I didn't take it. Next day, we rejected the bottom of the order block. I didn't take that either. But I got in here when we rejected this megaphone trend line. The megaphone trend line is when you have a low, a swing low, and then you have a lower swing low, and you connect those swing lows, and then the trend line goes out into space, into the future. If in the future you do come down symmetrically and touch this trend line, that's a decent location, and you very likely will have a reaction there. And that's exactly what I had on this trade. So I had a close under, close over this downward sloping megaphone trend line, but that happened inside of the bullish order block anyway. Remember, anywhere in this bullish order block is bullish, right? But I'm just trying to tighten it up and be more precise with my entry and looking for, a rejection of a 30 RSI inside the order block, a rejection of a major moving average inside the order block, which we didn't have in this trade. But what did we have inside this order block? We had this extension of this megaphone trend line that the previous day closed under, closed over. That's why I got in the trade. So I got in the trade 1162.87. I position sized. I placed my emergency stop, as always, 2 ATRs below. My end of bar stop, simply a close back under this trend line. That's it. I placed my trailing stop level 1.5 ATRs above. Next day, we take off. Perfect. Moved my way, hit multiple profit targets. Next day, up again, more profit targets, also got to trailing stop level. Next day, up again, another profit target. Next day, up again, another profit target. Remember, I'm in trailing stop mode. And so here on the 13th, we have our first close under a previous bar's low. After reaching trailing stop level, what do? I take off half of the remaining shares that I have. And so that's what I did. And on half, I locked in a gain of 4.66%. Now, the last 4 days for Netflix haven't been so great. We headed down. Well, I guess Friday was up here. And I did hit one profit target here. Now, again, where is my stop on this trade? Close below this trend line that is continuing to go out into the future. So the remaining shares that I have on Netflix, doing okay, up 3.02%, but you can see first close under previous bar's low after reaching trailing stop level. That told me potentially we might be going down, and that's why I took off half and locked in that 4.66%, and then the remaining shares that I have on the trade currently up 3.02. Coca-Cola, been a really, really nice trade, also utilizing this megaphone trend line. So let's take you all the way back. This order block started all the way back here on 4/7/25, right? We had a swing low, we had a swing high, we had a lower swing low, we had a higher, we went higher than the first swing high. designating this lowest bar close as the buyable area, bringing that into the future. And so I entered here 929.25. So why did I enter here? Well, again, we have the trend line. We have the swing low here connected with the swing low here. You connect the bottoms. That trend line goes out into the future. And like I said, many times you will have reactions if and when in the future you get to that trend line. You can see we got right here and bounce. But I got into the trade here on the 29th of September because we rejected the trend line. During the day, we were under it. We closed back above it. And we also had a V1. If you want to learn more about V1s, V2s, go to my YouTube channel. I have a video there. I'm not going to take the trade just because of the V1, but it does help the quality score. So again, why did I take the trade? One, we were in an order block. Two, we rejected the megaphone trend line. Three, we had a V1. So I entered here 929 at $66.03. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop, I want to keep close. What is it? Simply a close under that trend line. I placed my 1.5 ATR trailing stop level above, and off we go with the trade. Next day, started off good, hit a profit target. And we kind of moved down around here, kept going up, another profit target here, a couple profit targets here, one profit target here. Now I'm in trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I close below a previous bar's low, I get out of half. Next day, down, but did not close below the previous day low, kept me in. Next day, profit target. And then the last couple days have been really good on Coca-Cola. Thursday up, multiple profit targets. And then again, multiple profit targets on Friday. So this particular trade doing quite well. The remaining shares I have on Coca-Cola up 3.52%. Now, I have a rule in my trading that I do not hold through earnings. And earnings is coming up here, looks like on 10:21 in the morning. So I will have to exit this trade completely before earnings. So on the 20th, I will completely exit this trade and not hold through earnings. Holding through earnings is really a gamble. I don't want to gamble on a trade. So regardless of whether it was up, down, around before earnings, doesn't matter, I get out. So looks like I will be out. Let's see, the 21st is, when is the 21st? Tuesday. So I'll be out of this trade on Monday, regardless. So nice little trade, up 3.52%. Meta. All right. I took Meta here on the 7th of October. The previous day, we rejected that megaphone trend line, closed above it, but was a little extended. Didn't want to take that trade, but I did take it the very next day when we retested the high of the order block. I entered at 713.07. Now, my stop on this particular trade is this green line inside of the order block. And so why did I pick this green line? The green line goes back here to the halfway of 730.25. So this, if I buy this here, waiting for a close under this order block's a little far for me. It doesn't give such a good risk to reward ratio. So the halfway of that bar, 701.09, made more sense to me for a closer stop loss. So I entered here 713.07. Place my emergency stop 2 ATRs below. My end of bar stop is going to be a close below 701.90. I placed my 1.5 trailing ATR above. Next day up a little. Nothing to write home about. Next day up nicely. I hit multiple profit targets, but have not yet got to trailing stop level. Next day down big. No profit targets. Next day up a little bit. Can't remember if I had a profit target or not there. And now we've kind of moved sideways up a little on Friday. not enough for a profit target. But you can see here on the 14th, we did come to that level, that end of bar stop level. It was below it. Had it closed below what I would have gotten out, but it closed back above that, kept me in the trade. So this trade has not done a lot so far, but the remaining shares I have are up 0.56% of the trade, and I'll continue to stay in this trade unless it closes below 701.90. If it continues to move up, I'll continue to take profit targets with it. But this one up 0.56%. All right, let's go to NVIDIA. I took NVIDIA here on the 15th of October, so that was Wednesday. Why did I take it? Well, we have an order block here, folks, and we have a 50-day moving average, which is the gray line inside of it. On the day that I took this, I bought this at 179.92 with a rejection of the 50-day moving average inside the bullish order block. All right, so you might ask, well, where is the order block? This is a little bit of a tricky order block, but we have a swing low. We had a swing low and a swing high on the same day. This is a swing low. This is a swing high. We had a lower swing low. We moved up, that changed market structure. The lowest closing bar prior to market structure change was here on the 24th. The high and the low is the box that I drew into the future. So this is the area that I'm looking for a bounce. And the reason I took the trade was because that 50-day moving average, the gray line, is living inside of that order block, and that's why I entered. So I entered 179.70. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this gray line. Do you see how close that risk to reward is and how close I am to my end of bar stop? It's what I want. Place my 1.5 ATR trailing stop level above. And so far, we are up on the trade. Not a lot, but up 1.76% on the trade. No profit targets. You can see the 0.45 is 277. It was up, but it was only up $1.41. So not enough to get me a profit target, but up 1.76% on the trade. So we'll see what happens with this going forward. Disney. All right. I took Disney on Thursday, the 16th, at 109.86. And again, why? Well, has to do with two things. It has to do with the order block. This order block started, when did this start? Sometimes you have to go way back. Look at this. This order block was formed 5/23/25. So a long time ago, 5 months ago, right? When this order block happened, and we look here, wow. Was it smart money? Yeah, it was smart money. When you look at it here at the top, clearly that was smart money. So the thinking is, in the future, if it comes back to that smart money place, will it be smart money again? Maybe, maybe not, right? Again, things change. But I took the trade on Thursday because we rejected the 200-day moving average, the black line that resides inside the order block. Look, I entered here, 109.86. I position size. I placed my my emergency stop 2 ATRs below. My end of bar stop is simply a close under this 200. That's it, the black line. Next day, if it had closed even 10 cents, 15 cents, okay. I gave it a shot. It was a good setup. It didn't work. I'm out for small loss. Great. But thankfully, it did respond and respect that 200-day moving average. And so far, and I have not got to trailing stop level yet because I just barely got in this trade, but this trade is up 0.77%. Pfizer. Pfizer is a trade that I took on Friday. I took this yesterday. Again, why? Well, so we have an order block here on 925. We had a swing low, we had a swing high, we had a lower swing low, and then we had a huge change in market structure to the upside. And once you have the change in market structure to the upside, I can define the order block. Lowest closing bar before market structure change. Here's the high and the low. I bring it into the future. If we come back to the order block, I can potentially buy. I bought here on Friday at 24.51 for two reasons. One, we rejected the high of the order block. Two, we rejected the 200-day moving average, which is the black line. So I entered 241.51. I placed my emergency stop 2 ATRs below. My end of bar stop on this one, just going to be a close below the 200-day moving average. So I have a very small risk there. I have my emergency stop down here, in case something really goes wrong and it just hammers down on Monday, right? But that's why I used two stops, and then I placed my 1.5 ATR trailing stop level above. The other thing that I wanted to discuss with you on this particular trade, kind of a higher level concept, but when you have a big up move in the stock market, look at the volume. Does the volume confirm that there was a lot of momentum to the upside? You bet. I mean, look, these 2 days here, huge volume. Well, ever since we've had these two big up days, we have pulled back. But do you see how the volume came on low? It was low on the way down. It came on low volume, which is to be expected. There's a lot of profit in here. There was some profit taking happening, and this as it came down, but it came down on low volume. So what that's showing me is that there's not a lot of distribution on this stock. It's more of just a light profit taking, therefore the light volume. So anyway, we'll see what happens. This is a good setup. I don't know if it's going to work, but if it doesn't work, I know what I'm going to do. Monday, if it closes below the 200, I'm out of the trade. Monday, if it goes all the way down to my emergency stop, I'm going to get out of the trade. If it moves up, I'm going to take partial profits. If it gets to trailing stop level, I'm going to go into trailing stop mode. If I get up to 65, 70 RSIs, okay, then I'm going to look to potentially exit the entire trade. So this trade exactly even. I bought it right at the end of the day. This trade exactly even. Okay, so just a recap of the open positions. McDonald's remaining shares up 4.5%. Netflix remaining shares up 3.02%. Coca-Cola remaining shares up 3.52%. Meta remaining shares up 0.56%. NVDA remaining shares up 1.76%. Disney remaining shares up 0.77%. And Pfizer exactly even because I just took the trade. All right. Now, those are the open dailies. Let's go to the daily positions that I had to close last week. Okay, so I took Costco here on the 13th of October at 935.56. This is what is called a higher low V1. A higher low V1, one of my favorite trades really, has to do with the value zone. You can see here's a green line here, here's a green line here. Anytime you are beneath the high, between the top, anytime you're below the top green line and above the bottom green line, you are in the value zone. So a higher low V1 or V2, the requirement is, first of all, you have to have a close below the value zone. Well, here's the green line. We are below it. We are closing below it. The second requirement is that you have to come into the value zone, which we did. The third requirement is that you have to have a pullback followed by a V1 or a V2. Well, this is a V1. Why is it a V1? V1 consists of two bars, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. That is called a higher low V1 because this low here is higher than the previous. So higher low V1 in the value zone has to close in the value zone. Well, that's what it did. So I got into the trade 935.56. I position size. I placed my emergency stop as always, 2 ATRs below. My end of bar stop on a higher low V1 or V2 is a close below halfway of the V1 or V2 washout bar. So this was the washout bar. It's a washout bar because it washed out or went below bar one's low. So you see my line here, 928.70. This is my line in the sand. If in the future it closes below this line, I am out. So I took the trade, 935.56. The next day, right off to the races like a rocket ship up. What did I do? I sold into that strength with intraday profit targets, right? Next day, again, hugely up, hit multiple profit targets. So you can see why it was so important to me that because this ended up being a losing trade, that at least I got off some of the shares at very profitable levels, and it helped mitigate the loss on the trade. So higher low V1, 935.56, multiple profit targets the next day. Again, multiple profit targets the next day. Got to trailing stop level, but then Thursday we hit that big, huge down bar, which clearly closed below the low of the previous bar's low, but more importantly, it closed below my end of bar stop. So I had to get out, and the remaining shares that I had on that trade, I lost 1.05%. So not a big loss as far as percentage-wise, but it's a good teaching moment, everyone, of do you see how important it is I took some of the profit while I had it? But nonetheless, Costco ended up with a loss of 1.05%, closed below my end of bar stop. I'm out of the trade. Okay, VIX. VIX has been a really great trade, and this was an order block trade. I'll define the order block for you. Swing low, swing high, lower swing low, then we change market structure to the upside by taking out the swing high. That defines the order block. The order block started on 9/18/25, the high and the low of the order block, bringing the order block into the future. I mentioned on this on the podcast a couple weeks ago. I said, look, everybody, we have this bullish order block in VIX. We're coming back into the order block. This is where I'm looking for a long. If I'm right and it bounces here, very likely the short-term top of the market is going to be in, right? So as soon as this price got back into this order block, I was thinking, it's very likely that we're going to have a pullback in the market, and this is exactly what happened. So this order block right here really kind of looked into the future a little bit and gave a good calculated a calculated guess, right? A calculated guess at the market was probably at a top, and that's exactly what it did. So I took the trade on VIX here on the 7th because we rejected the order block. The previous day we were in the order block. We closed above the order block. That's a rejection of the high of the order block, right? And in addition, we went red to green on the impulse, which I talked a little bit about last week. It's a little difficult to explain, but it's showing that momentum was really down and then immediately went up, and that's exactly what happened. So this is why I took the trade at 33.17. My end of bar stop was a close 2.8, or my emergency stop was a close 2 ATRs below, and my end of bar stop was simply a close below the low of the order block. I placed my 1.5 ATR trailing stop level above. Next day we were down a little bit, and then here on the 10th we had a huge move up. I think I hit 6 profit targets. I usually just put in 3, but as it kept going up, I kept putting in the profit targets, and it had a huge move up that I sold into this strength. Then the next day we were down, but then we continued up. Multiple profit targets here. Had another profit target again there. Thursday, many profit targets again, and then on Thursday, we got to a 65 RSI. And again, if you get to a 65 RSI and then you have a close below a 5 EMA, which is the blue line, that's my exit. Well, that's what happened on Friday. We closed below the 5 EMA after reaching 65 RSI level. And so I closed out the entire trade, and the remaining shares, the remaining shares that I closed out on Friday, yesterday, up 8.53%. So a really good trade. But again, Thursday's big up bar, I sold a lot more at much higher levels. So this was a good trade, and it was really a good example indicator of if VIX changes market structure to the upside, pulls back, and then bounces in there, very likely you're going to see the opposite. The market do the opposite and go down, and that's exactly what happened. So this gave a little insight, calculated assumption in the future that the market was going to go down, and that's exactly what happened. So up 8.53% remaining shares. Okay, BITO. All right. So this one did not work out so well, but this is how it goes sometimes. This is BITO. This is Bitcoin. I entered Bitcoin here on the 5th of September at 1992. Why? It was a bullish abandoned baby. A bullish abandoned baby happens when you have a gap down immediately followed by a gap up. And that's what we had. You can see here, we gapped down. Very next day, we gapped up. So when you change from bearish to bullish in a very quick manner, very likely in the future, about over 70% of the time, you're going to be higher when that happens compared to lower. So this particular trade, this is the only trade setup that I take where I don't take partial profits. All I do is I put a 2 ATR stop and a 4 ATR profit target. This is how strong these are. So it's a set it and forget it type of trade. I'm either going to lose 1% of my account or I'm going to make 2% of my account. 2 ATR stop, 4 ATR profit target. I wait for the abandoned baby. I got in at 1923. It started off great and then pulled back, and then boom, we started to really move up. I said, oh, this one I think I'm going to hit the 4 ATR profit target, but was not to be. And then, of course, Bitcoin has just sold off dramatically. On Thursday, I did hit my 2 ATR loss for a loss of 6.01%. Now, would I take this trade again? 100%. Because like I said, over 70% of the time, I tend to hit my 4 ATR profit target. 30% of the time, I tend to hit my 2 ATR stop loss. Well, this was just one of those times where I did hit the 2 ATR. But the important part here is that I'm risking 2 ATRs to make 4 ATRs, and more times than not, I hit the 4 ATR instead of the 2 ATR loss, right? But this one did have a loss of 6.01%. So on the recap on the dailies, Costco remaining shares a loss of 1.05%. VIX remaining shares with a gain of 8.53%, and with Bitcoin, the Bitcoin abandoned baby trade, a loss of 6.01%. All right, so those are all the daily trades. I know there was a lot of them. I'm sorry, but you know, if you like seeing the process and how I'm managing each one repetitive, well, you got it today, right? Now, let's go to the weekly trades. I also trade weekly bars. Weekly bars close on a Friday, so I have to make my decisions on a Friday. And so these are all weekly bars. Let me make sure yeah, okay. This has been a really good trade on XLV. XLV is the healthcare ETF. So I entered XLV here on the 8th of August at 130.07. Why? Well, orange line is a major moving average. That's the 300-day moving average that lives inside an order block. Anytime we get to an order block and there's a major moving average or a 30 RSI level or a megaphone trend line, that's where I want to look to enter. So I did enter here 130.07 with a bounce at the 300-day moving average and a close and rejection of the top of the order block. So I position size correctly. I placed my emergency stop 2 ATRs below as always. My end of bar stop is simply a close below the 300-day moving average. I placed my 1.5 ATR trailing stop level above. And next week, off to the races like a rocket ship. Up. Hit multiple profit targets. Next week, up again. Hit another profit target. Got to trailing stop level. Then we moved sideways for about a month. Here on the 26th was our first close below a previous bar's low. After reaching trailing stop level, what did I do? I took off half of the position that I have for a gain of 3.99%. Next week, up biggies. multiple profit targets. And then the last couple of weeks we've come down, or the next week we came down a little bit. We were up a little bit this week. We have not got to a 65 RSI level, so the 5 EMA has not come into play. So the remaining shares that I have on this particular trade up 9.16%. So that's been a really nice trade. UUP. All right, UUP is the dollar. I entered the dollar all the way back here on the 7/11, July 11th. Multiple confluence of entries. We rejected the high of the order block. You can see the previous bar, we closed in it. We closed back above it. We also closed under the 200-week moving average, closed above it. That was my entry, 27.21. Placed my emergency stop 2 ATRs below. Placed my 1.5 trailing stop level above. Next week, we're up. Profit target. Next week, down. Next week, up. Biggies. Multiple profit targets. I'm also in trailing stop mode now. Couple of weeks later, we had our first close below a previous bar's low. After reaching trailing stop level, what did I do? I took off half of the trade for a gain of 0.51%. Now we have moved sideways for several, 2 months, moved sideways, and now we finally moved to break out of that. The week before, moved up, profit target this week down a little bit. So this particular, the remaining shares that I have on this particular trade are up 1.98%. TLT on the weekly, I have been in this trade, seems like about 38 years, but actually it's been about 10 months, but it feels like that. I entered the trade all the way back here on January 17th. Rejection of the high of the order block plus a V1. I got in 87.20. The next couple months just went up, and I took partial profits when I was supposed to. I got to trailing stop level, but I did take off quite a lot of profit targets into this move. Then here on 4/11, we had a big sell-off in the bond market. I had to close below a previous bar's low after reaching trailing stop level. I had to lock in half of the position for a loss of 0.58%. After that, we've moved up, we've moved down, but we never closed below the low of the order block. That kept me in the trade. On up moves, I took partial profits. And the remaining shares that I have at this moment on TLT up 4.36%, which, listen, it's not bad, but I've been in this trade a long time. But the saving grace on this trade, usually I'm not in a trade for 9 months to make 4%, right? But TLT does pay a monthly dividend, and the annual rate on that dividend is above 4%. So all in all, this has been about 8% if you throw in the dividend. There are some times where you have a position that doesn't go down enough for you to get out. It doesn't go high enough for you to get out, but it just keeps you in. And, you know, if you're getting paid a dividend at the same time, that's fine. So the remaining shares I have on TLT up 4.36%. I'm really hoping one day to be out of this trade because I'm tired of talking about it. I'm sure you guys are tired of hearing me talk about it, but I just want to show you that I'm sticking with the process and doing what I'm supposed to do, but up 4.36%. All right, last but not least, thankfully, Amazon. Okay, so you hear me talk about bullish order blocks. There is also something called a bearish order block. And a bearish order block I mark in red. So let's quickly touch on what makes a bearish order block. It's the opposite of a bullish order block. You need to swing high, followed by a swing low, followed by a higher swing high, and then a move down that takes out the swing low. Well, that changes market structure to the downside. And now the highest up bar close before market structure change is the sellable area. We move this into the future. Now, if we look at this bar here, could we say that smart money was selling up here? Yes, right? If we're all the way down here and we look in the past, who were these people buying up here? Well, that was smart money that was selling. So therefore, if in the future we come back up into the place where the smart money was selling, will they be selling again? Not for sure, but more than likely. Okay. So I picked this level here, 233.70, as my line inside the bearish order block. Sometimes we have moving averages, sometimes we have trend lines, but on this particular one, the reason that I picked this 233.70 was this big down bar here on the 7th. If you have a big down bar and you rally back to halfway that big down bar, there can be a lot of times where that is going to be resistance. And so I wanted to find a legitimate resistance level inside the already bearish order block. So that's what I did, and that is where I took the short trade here on the 15th of August, because we rejected this level and closed below. So I got short at 230.90. I position size. I placed my emergency stop at 2 ATRs above. My end of bar stop on this is simply a close below this red line. A close above this red line at 233.70. So it's very close. My risk to reward ratio is really good. So I enter 230.90, place my emergency stop 2 ATRs above. My end of bar stop's a close above 233.70. 233.70. And then I place my 1.5 ATR trailing stop level 1.5 below. And off we go. So for the next week, it did go down. I hit a profit target. Next week, up again. Down at one point, I hit a profit target here, but then we rallied, but we did not close above that 233.70. The next week, up again. I thought, well, I'm going to get stopped here, but there was not enough buyers to keep it above. It closed below. Next week, attempted again. See, that 233.70 level is pretty good. Look, the market flirted with it many times, but then we finally kind of broke to the downside. This week here, I hit multiple profit targets, and then this week here, also a profit target, not the trailing stop level. So this trade has done pretty well, really. The remaining shares that I have on this short position on Amazon up 8.32% on the short. Earnings coming up here on the 30th, so regardless, I will exit the trade. But really good trade, actually, up 8.32%. So recap on the weeklies for those keeping score. XLV remaining shares up 9.16%. UUP up remaining shares up 1.88%. TLT remaining shares up 4.36%. And Amazon remaining shares on the short up 8.32%. So those are all the positions that I have, dailies, weeklies, and you can see they were not all winners, right? They're not all winners, but the majority of them are winners, and and more importantly, some of the winners double digits, right? Only had one loss on Bitcoin that was significant, but in trading, obviously, it's okay to have big gains. It's okay to have small gains. It's okay to have break-even trades even. It's okay to have small losses. But what you have to keep yourself from having, and you need to set up and structure the trade so this doesn't happen, is that you don't have multiple big losing trades. And that's the key. And that's what I tried to show you here, right? A lot more winners than losers. The gains on average much higher than the losers. And that's why things are profitable. And hopefully that's what you can get to as well. So let's talk a little bit about trader psychology, and then we will get on to the potential trades for next week. All right, this is from my good friend Steve Burns. You can follow Steve at sjosephburns over on X. Steve has had a big impact on my trading. He was a coach and mentor of mine many years ago. He writes such great trading books. You can find all of Steve's trading books on Amazon.com. But he's a great trading coach. He's a great author, great trader, and I really learned a lot from Steve and really respect Steve. And he writes the best posts about trading psychology, so that is why I often pull from this on X. But let's see what Steve has to say. And when I read this, I was like, oh man, I totally agree with that because I have always felt this way. Let's see what he has to say. Your position sizing determines your trading destiny regardless of all other factors. Your position sizing determines your trading destiny regardless of all other factors. So in other words, your position sizing is going to determine whether you make money or lose money more than anything else, more than your signals, more than your stop losses, right? The most important thing in trading literally is how many shares you buy or how many contracts you buy if you're going to be buy futures, right? You could have the best trade setup in the world, but if you position size too large and you're wrong, that's all she wrote, right? Like, I'm all about good trading setups, multiple confluences, lining up, great, but I'm not going to bet the farm on it because they don't always win, right? So that's why the formula that I use, 1% of your trading capital divided by the value of your 2 ATR, if you just stick with that formula, that's a simple formula, but it factors a lot of complex things into how much you have and what the volatility of the market is. That's why I am such a huge proponent of position sizing correctly. It has to be large enough that it makes a difference, and it can be substantial if you're right, but it can't be so large that if you're wrong, you get wiped out. Or it's so large. Another thing that happens is if you have really large positions, then it's harder to follow your process. So it's a fine line. I mean, it really is a delicate balance with your how many shares you buy, because ultimately you have to follow your trading process in order to succeed in trading. But if it's too small, well, think about it. If it's really small, okay, it's going to be pretty easy to follow. You buy 2 shares, okay, you're not sweating it. So yeah, you can follow it. But if you buy 2,000 shares, oof, now there's a lot of heat on that particular trade, and you may just get out emotionally. So it's a fine balance. But in my experience, 1% of your total trading capital divided by the 2 ATR works really good. If you're right, you have the ability to make some serious money. If you're wrong, it's not that big, right? Hopefully, if your stop loss is close. So it's important to learn about trading, technical analysis, setups, processes, all extremely important. But remember, it starts with your position size. And like Steve says right here, your position sizing determines your trading destiny regardless of all other factors. So you've got to get that right. That's the first place to start. Make sure you're position sizing correctly based upon volatility. Thank you, Steve. Appreciate that. Follow Steve at @SJosephBurns on Twitter. Check out his books on Amazon. All right, everybody, let's head over and let's look at some of the potential trades for next week. Now, I always say this, that here I have, here we go. Here I have 11 different symbols. Vivek and I, as I mentioned earlier, he accompanied me last night on my analysis of the potential setups. And this is what I came up with. Now, here are 11 different symbols. It is potential next week that all 11 of these could potentially trigger on the same day. So does that mean that I would take all 11 trades on the same day? The answer is absolutely not. I really strive to only take one trade per day. Even if I have 5, 6, 11 signals that happen on the same day, I have to narrow them down to the best one. I give every potential setup a quality score. So if I have 11, out of those 11 that are legit, there's going to be one that's better than the other. And how do I do that? Well, like I said, I give it a quality score. If one setup has 1 entry signal, okay, there's 1. If another setup has 2 entry signals, there's 2. If the third has 3, there's 3. Which one do you think I'm going to take? I'm going to take the one that has the score of 3 instead of 1. But then we also have to look at Other things like what's the risk to reward. You could have 5 entry signals that are great, but the risk to reward's horrible. Okay, maybe you don't take that one. I like to look at the longer time frames to see if there's some technical things going on in higher time frames. In other words, if I'm trading daily, I want to look to the weeklies to see if there's some type of support on weeklies. I want to look at the relative strength of a market. Maybe the market's down, but maybe one is up while everything else is down. Well, it gets extra bonus points for that. Then you throw in V1s, V2s, you throw in double bottoms, bullish MACD divergences, you throw in a trend line like we talked about, right? So there's a lot to trading. It's not that easy. And you have to be very precise and diligent and have a process and disciplined. And, you know, it's not as easy as people think. And so, I'm a trading coach. I teach people all over the world. I teach people from absolute beginners all the way up to the hedge fund level and everywhere in between. And so, I do teach a 20-hour course. It's a one-on-one course. With my students, it's 2 hours at a time, once a week for 10 weeks. So we spend a lot of time together. I teach you all of my setups. I teach you all of my strategies. I teach you all the rules. I put you through tests. We do simulation trades so that I know that you know what you're doing. And I have turned out some great, great traders. I've been teaching for a long time now, many, many, many years, people all over the world. And I have turned out some really great traders. And so, if you would like to study with me, if you'd like to become my student, if you would like me to teach you everything that I know as a professional trader with over 30 years of experience, I'd love to have you as a student. And what you need to do is just send me an email. The email is in the link of this YouTube video. If you send me an email, I'll reply. I'll say, hey, let's have a video call. It's free call. I just want to learn more about you, your trading challenges, your goals. It's a good time for you to ask me any questions about the course. It's not a sales call, I promise you. I have a lot of students. It's not a sales call. I just want to make sure that we are a good fit. And if we are, we can move forward. And like I said, I'll teach you everything that I know. So that's the 20-hour course, one-on-one course. As an alternative, I also have a really good Udemy course where I teach you step-by-step how to trade the deep dip buy. I've talked about deep dip buy a little bit today. It's a really good place to get started. It's 9.5 hours of video. It's very affordable. It's somewhere between $50 and $100 for the whole course, and I've sold so many of those around the world, and so that's a good place. So either the Udemy video course, links in the description, or contact me and we can set up the one-on-one course, the 20 hours. So that's my plug for the show. So if I can help you with that, or if I can help you with any other issues of trading or consulting, just please contact me. All right. So, but again, here's 11 setups. I'm only going to take one per day, right? The best one that has the best signals, the best risk to reward ratio, the overall best quality score. Okay, so let's start with Amazon. Now, this one's a little tricky because I am in this trade already. We just talked about it. I'm in this trade short on the weekly. It's been a great trade, right? But although I am not going to take this, this is a good potential setup on the daily for buy, so I wanted to share it with you. So if we look at Amazon, we are currently in a bullish order block, right? Why? Well, we have an order block here from 8/4/25. And then the order block happened, and then we took off to the moon. Once we were at the moon, we look back and go, man, I should have bought down there. That was smart money buying there. Well, we are right back down to where the smart money was again. And on this particular trade, there's some interesting things happening inside the order block. Here's a 200-day moving average. Here's a 250-day moving average. Friday, we rejected the bottom of the order block. That by itself is a legitimate signal. But again, I did not take it because I am short from the weekly, from a different time frame, and I'm short. But we are getting on the daily, so I want to show you this. Also, we talked about the megaphone trend line. Here's a swing low. Here's a swing low. We connect the swing lows. We bring this trend line out into the future. Magic presto. We had a reaction and rejected the bottom of the order. Rejected the bottom of this trend line. So going forward from here, if I were to take a long position again in Amazon, which I can't because I'm short, but it's a good teaching moment, another rejection of the bottom of the order block would be legit. A close above the 250-day moving average would be legit. A close above the 200-day moving average would also be a legit long entry. Now, earnings are here on 10:30. As I mentioned, I'm short, so I will be getting out. If I got long, I would also get out before earnings. But I like that we rejected the megaphone trend line. And if I had to say ideally what I'd be looking for, I would be looking for another rejection of the trend line and recover of the trend line and a bottom and rejection of the bottom of the order block as well. Like I always like them lower than higher, but a close back above the 250 would be legit. A close above the 200 would be legit. But my preference, if I were to get long again, would be another rejection of the bottom of the order block, a test of the bottom of the order block and recovers. And by default, it would also reject the trend line and recover. That is ideally where I like to look. On top of this, everybody, look at the MACDs. MACD's momentum bars. We have a low here with deep red MACD bars. Then we have a rally to green. Well, now we are lower here than over here, right? These bars are not as deep as over here. That is called a double bottom with the bullish MACD divergence. That is also another indicator showing that more than likely we are ready for a bounce. Not for sure. But if you add it all up, order block, rejection of the trend line, double bottom bullish divergences, a bounce from this area, not surprising at all. So, keep an eye on Amazon, see what happens with that. DoorDash. All right. DoorDash just went up and up and up and up and up and up and up, but we have changed market structure on DoorDash to a big way. Swing high, swing low, higher swing high, market structure change. Once you change market structure change to the downside, you can identify the bearish order block, highest up bar close before market structure change. Anywhere in this red box would be, from a technical standpoint, a legitimate type of shorting area. And there's a lot going on here. A lot as far as levels. But I'm going to make this simple. You can see the bottom of the trend lines here. Well, we broke the trend line to the downside. Now this trend line is resistance above you. And if we move up, we've had this big move down. If we now move back up to this trend line is going to be difficult to get over, right? It's going to give some technical resistance above. In addition to that, the low of the order block, the red box, dovetails right here. So if DoorDash rallies next week and rejects this trend line, meaning during the day it went above it, closed below it, or it just bounced there and closed below it, I very likely will take a short on that. My end of bar stop would simply be a close up back above that trend line in the future. But this looks very heavy to me. As a matter of fact, the whole market looks heavy. Yes, we've rallied and whatever, but I think we're going to have a tough time continuing up. But we'll see. But, just to be clear here, I'm looking next week for a rejection of either the bottom of the order block. The bottom of the order block looks like 273.68 and or a rejection of this trend line. Energy transfer, ET. Okay, I've been waiting on this one, stalking this one for a long time, waiting for it to come exactly where I want to get it. I would love to be able to buy ET at this price. Well, we have this order block way below us here. This order block started here on the 6th of May. In addition to the order block that's below us, I have connected these two bottom lines here, megaphone trend line. Well, this megaphone trend line tracks into the bullish order block, right? That's pretty nice. So I don't know if ET is going to get down here next week or in the future, but if it does, and it comes and it rejects either potentially the top of the order block or rejects the uh, megaphone trend line, I would certainly consider getting long there. And in addition to that, if we do come down into this order block area, very likely we'll be in the 30 RSI range. So under 30, over 30 inside a bullish order block, great. Under 30, over 30 inside a bullish order block and a rejection of a long-term megaphone trend line, even better. So right about here, maybe somewhere 1560 up to 1580 is really the place that I'm looking for. And this would be a nice long-term trade. This yields almost 8% a year just in dividends. Of course, the lower it goes, the better the yield, right? But just because something has a good yield doesn't mean I'm going to buy it. But if you have a good entry spot to start with and it pays that, great. So that's what I'm looking for. Potential rejection of the high of the order block at about 1580 or a rejection of the trend line, which is about 1560. FedEx, FDX, okay. Another bearish order block. Why? Swing high, swing low, higher swing high. Market structure changed to the downside. Now we have an order block. The high of that bearish order block is 250.09. The low is 243.61. Move it into the future. Aha! In addition, this was a previous trend line that was broken to the downside. If you break it to the downside and rally back up to it, it is resistance. So I'll be looking for a short on FedEx with a rejection of the low of the order block at 243.61 and or a rejection of the trend line. This trend line's moving, so I can't give you an exact number. But if it rejects but the trend line is clearly inside of the bearish order block, so rejection there. So I'm looking for a short on FedEx there. GDX, which is the gold miners. Gold miners have been on a tear. But we did create an abandoned baby on Friday on GDX. Why is this a bearish abandoned baby? Because on Wednesday we gapped up, and then Friday we gapped down. Gap up, gap down, there's your abandoned baby. Does this mean I short right here? I could, but really what I'm looking for, the bottom of this abandoned baby here at 81.70, that's the real key point that I'm looking for. I'm looking for an attempted rally back up to test the bottom of the order block and fails. And if it does that, then very likely if I get into the trade, I will get in. And just like with Bitcoin, I'll put a 2 ATR stop to the upside and a 4 ATR profit target to the downside. So essentially looking for a rejection of 81.70 next week for a short. Goldman Sachs, GS. Well, apparently everybody wanted to buy up here. Now everyone wants to sell. Look, this is a nice little hidden order block from 821. It's a very narrow order block. The high is 715, the low is 709.17. Bring that into the future. Again, if you look up here, where the smart money buying here, yes. If we get back down to the smart money area, will it bounce? Maybe, maybe not, but more than likely. And so right now the RSI is 39.83. Depending how long it takes us and how quickly we come down here, if we ever come down here, an under 30, over 30 inside of that bullish order block would be fantastic. Doesn't have to be an under 30, over 30. That would just help. But in the future, if we continue down and we reject the high of this order block, sure, I may potentially take a shot there because this order block is not very tall. So the it's a good risk to reward. So I'm looking essentially for a rejection of 715.66 at the top or a rejection of 709.13 at the bottom. And that's what I'm looking for. Don't know if it's going to get there, but if it does, I've identified the area. Morgan Stanley. MS. Okay, well, we have a bullish order block here. Swing low, swing high, lower swing low, market structure change. The market structure change identifies the lowest closing bar before market structure change. It's kind of a tall order block, a lot of risk. What I'm looking for is this 50-day moving average inside the bullish order block. Here's the gray line, right? That's about the only place that I will consider getting long Morgan Stanley is next week if we reject the 50-day moving average, the gray line inside the order block, and that 50 is 152.93. Microsoft. Okay, I've talked about this for a couple weeks now. We have a very wide order block. It rejected the high of the order block. Does that mean I'm going to take it? No, because look the risk to reward all the way down here. I'm looking next week for a rejection of the 100-day moving average inside the bullish order block, 502.77. Right now we're 513.58. It could get there. I promise you it could get there. But if it doesn't get there, I won't take it. But next week, if we come down and we reject the 100-day moving average in the order block, I consider taking it. My end of bar stop would be a close below the 100. S&P 500. Okay, well, here's the market as a whole. Of course, back here on the 10th, we had a big move down, change market structure to the downside. Therefore, we have a bearish order block above. The order block is the highest up bar close before market structure change. The high of that order block is 673.21. The low is 669.42. We broke the trend line to the downside. Now this trend line is resistance above us. So next week, I could potentially get short the SPY with the rejection of the low of the order block at 669.42. I could really the ideal place would be a rejection of the high of the order block, 673.21, because that coincides with that trend line above as well. So we could certainly continue this rally back up into this order block, but in my experience, the market's going to have a tough time up here, breaking out and going through new highs. But we'll see. Oil. All right, oil, I like oil a lot. USO. Not quite there yet. Obviously, oil has sold off dramatically. We have a nice order block all the way here on May 30th. Swing low, swing high, or swing low, swing high, lower swing low, market structure change. Up here, looks like the smart money was buying down here. Now we are getting back to that smart money area. This is a very short order block. It's not very wide. So I'm looking for a rejection next week to get long oil with a high rejection of the high at 67.25 or a low at 65.96. That is the area of the order block. So rejection of the high of the order block, just roughly there. So let's see, give me exact numbers here. 67.25 is the high. The low is 65.96. Some kind of rejection of either of these levels would be legitimate entry, or inside of the order block, if we have an under 30, over 30 inside the order block, that would also be legitimate. So I'm going to watch that very closely. Last but not least is XLF. I really do like this particular trade. We have a nice order block that started here on the 1st of August, and we have the 200-day moving average right at the bottom of the order block. This, to me, it looks like a no-brainer. Doesn't mean it's going to work, but if, and only if, we come down and we reject that 200-day moving average inside that bullish order block, that's a key area. So I'll be watching that very closely. The 200 is at 51.04. So there you go, everybody. Those are the setups that I'm looking for next week. I hope you found the podcast helpful. If you did, I really would appreciate hitting the thumbs up button. It really helps, lets YouTube know there's some valuable content. If you haven't subscribed, please subscribe. If I can help you with your trading, I'd be happy to do it. If you want to do the 20-hour one-on-one course with me, it'd be great to have you as a student. Just send me an email, and we'll get the conversation started. You know, if you want to do any private consulting for anything else, just contact me. Happy to help you with that. Keep in mind, the Udemy course for the deep dip buy, that's a great place to get started. If you have any comments or questions about anything I went through today, please put them in the comment section. I'll do my best to get back to you. I always like to leave off with please try to do something nice for another human being today. If we all did one nice thing for another human being every day, really the world would be a better place. If you could also find it in your heart, if you could do one nice thing for an animal each day, that would just make the world a better place too. They appreciate acts of kindness just like we do. So thanks a lot, everybody, if you made it through here. I hope you found it helpful. God willing, I will see you next week. But please be careful. Please remember what I just showed you on the S&P chart. Yes, we had the big sell-off. Yes, we're rallying. We're coming into that bearish order block. Higher percentage than not, we fail there. So keep that in mind with your trading. And again, have a good rest of your week. Good rest of your weekend, everybody. Be careful next week. Follow your process. Follow your rules. And if I can help, just let me know. Thanks a lot, everybody. Take care. Bye-bye.
U.S. government require disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.